Thank you. Good afternoon. A Menti quiz is always a hard act to follow, but I will try to do my best. I'm Saurabh. I lead the fintech and e-commerce business for TransUnion India. And I've been a part of the fintech ecosystem since 2012. I've had the unique privilege of watching this global revolution with a ringside seat. I've also had the privilege of working very closely with over 200 fintech founders in India in transforming their businesses by leveraging technology and data analytics. In today's session, I hope to bring some of these learnings and some of these trends which connect back to future growth areas for the fintech ecosystem in Philippines. Now, I'm aware I'm manning the graveyard shift, which is the post-lunch shift with Yogesh, as it is called. So I'll try to do my best to keep it very interesting and relatable. Without any further ado, let me dive right into today's agenda. Okay, so first and foremost, we will start with a global fintech perspective. We will compare a couple of markets across emerging geographies as well as mature geographies. Once we've selected a good peer growth market to benchmark Philippines with, what we will do is we will look at the state of the union of that peer growth fintech market. And within it, we will look at some of the macro growth drivers, followed by trends as well as evolutionary phases that have defined the entire journey for fintechs in that market. We will also look at certain differentiation strategies that have allowed fintechs to differentiate and carve out market share from traditional players in those markets. Finally, we will go to the fintech sweet spot, which happens to be small ticket personal loans. And we will look at some contrasts between the small ticket PL market in Philippines as done by fintechs with that of the growth market. And finally, round it up with some learnings and takeaways. All right, so let's first start with our global fintech perspective. What is a fintech? A fintech is an entity that is digital first in all of its approaches. It uses abundantly disruptive technology to create differentiated consumer experiences whilst offering financial products. And this differentiation and consumer experience disruption happens across onboarding, KYC identity as well as eligibility checks. It happens across underwriting, issuances, and then finally also across cross-sell of other financial products as well as managing consumers through their life cycle and collecting on consumers. They typically rely heavily on venture capital investments, which happens to be their lifeblood globally. Of course, a few lucky ones that grow beyond the VC stage tap into public markets as well as private equity. And finally, they have this ability to rapidly experiment and innovate, be far more nimble than traditional incumbent players in that market, and that allows them to scale and evolve much more rapidly than other traditional players. We've seen this play out in the last 2 decades, right? Post the global financial crisis of 2008, what we saw is in 2 decades, the amount of disruption that's happened globally in financial markets is probably more than what the financial markets have seen in the last 2 centuries. And it is largely because of tech-led disruption. But it has its downsides as well. There are times when regulation tends to lag innovation. There are times when fintechs end up going and disrupting and innovating in areas which are just interpreted as regulatorily kosher but may not be. We've seen that there are no uniform and comprehensive fintech regulations that exist in any market. Of course, you can pick markets where there are segments that are well regulated. You can look at UK where open banking and digital banking regulations are fairly strong. You can look at India, where digital payments and digital credit regulations are there, but fintech regulations are about to come in. The US, where credit related regulations exist, but at the same time, buy now, pay later regulations are still absent. I would say when it comes to regulation, probably Singapore has the most comprehensive and advanced regulation and regulatory frameworks that exist today. Now, a BCG study said that fintech revenue of publicly listed fintechs is set to cross $1.5 trillion by 2030. And what's really interesting is that APAC will play the biggest role. In 2030, APAC as a region will account for 600 billion of that revenue, that 1.5 trillion we spoke about. It will overtake North America, which will be at 520. The highest growth rates will of course be in LATAM and Africa, but at the same time they will be much smaller in terms of absolutes. When you look at the distribution of global fintech unicorns, you'll realize that there are 165 plus fintech unicorns that exist globally. They're together valued at $2.1 trillion plus. By the way, the United States today accounts for 51% of those fintech unicorns, which basically means the United States has more unicorns than the rest of the world put together, right? And also, in terms of significance, just the scale that they have, it is head and shoulders above any other region or, for that matter, country. But let me also give you a little bit of perspective here. What we've seen is in the US, there are the behemoths like a PayPal, a SoFi, and a Firm, a Block. From a region perspective, Europe comes second, but at the same time, from a country-specific perspective, China actually is number 2. China already has 13 plus fintech unicorns, but having said that, we have the Ant Financial Group, part of the Alibaba Group, which is a massive, very highly valued fintech globally. After China, we've got India and the UK come in a close third at 11 unicorns each. Now, in terms of active fintechs itself, when you look at the top 20 countries globally, what you'll find is the US still leads the charge. The US has 5,730 active fintechs. These are, by the way, homegrown fintechs only. This count does not factor in other fintechs from other geographies that have set up shop in the US. Similarly, UK comes second. India is the world's third largest active market for fintechs that are homegrown. And the top 20 countries, by the way, account for more than 50% share of all fintechs that exist globally. Except Africa, all other regions are today well represented in that top 20 countries list. Now let's move our focus a little bit to APAC and Asia specifically. And what you have on the slide is the top 15 countries where, of course, we've removed China just because it's hard to track trends in China currently, which leaves India as the number 1 Asian market in terms of just the scale of fintechs that operate there. And then comes Singapore, followed by Israel, UAE, Hong Kong, and Indonesia, which round up the top 5. The Philippines, by the way, interestingly, is the 5th largest when it comes to Southeast Asia, at about 131 homegrown fintechs that exist. By the way, Philippines is already home to over 280 plus fintech entities that operate. But it's important to note in Philippines, there are a lot of fintechs which have come in from other regions, and that's the interesting dynamic that exists today. And that's healthy competition to locally grown fintechs. Now let's look at the funding trend that has played out, right? While we all know that fintech funding reached its peak in 2021 and 2022, even though many regions were going through their lockdowns and phased opening from the COVID lockdowns. What we found is a deep dive or off the cliff jump for fintech funding in H1 of 22. What we've seen is a degrowth of 44% when you compare against the same time in 2021. Sorry, let me just restate that. We've seen a degrowth of 44% in H1 of 23 versus H1 of 22. You will see though on the previous slide, sorry I switched, but it is still heavily relying on VC funding versus PE funding, right? Like I said, VC funding still remains the main lifeblood. Now, when you look at the regional focus, you'll find that North America still accounts for the lion's share there, right? At 65% of the entire funding of 46 billion that we saw, and that's at 22.3 billion. When you filter it down by three important fintech segments that are the primary leading segments, we've got digital payments, digital banking and buy now pay later, as well as lending, which accounted for 34 billion of the 46 billion that was raised in H1 of 2023. Asia, by the way, is a close second. I say close only because the growth rate is really, really faster than North America. Now, let's take a look again at funding, but from a segment focused standpoint. And what you'll find is right now, payments still globally continues to lead. However, it is seeing challenges globally across markets on profitability, and the path to profitability for digital payment firms is leading them to start lending players, either directly or in partnership with other larger lenders by leveraging their large consumer bases. The next one is digital lending, which has accelerated post the pandemic, right? However, there is a little bit of, on book focus, because what has happened in multiple geographies is digital lenders have started with just a lead sourcing model where they pass on the lead to a larger bank and they say, we're a digital lender. That is not going to attract VC money anymore going forward. The clear focus is for you to do on-book lending, manage the entire risk, and derive net interest margin revenue rather than a commission or a lead payout model, right? And finally, digital banking and buy now pay later is attracting off late a lot of interest from VCs. That's been a key trend that's played out post-COVID with the rise in digitization and the scale of e-commerce in most emerging markets. Now, remember we spoke about selecting a peer growth market, right, to compare Philippines with. Now, when I look at Philippines, while the total population at 117 million is not really similar to any of the other markets that I've picked for comparison, and I've picked India as one more emerging market to compare with. And I've picked two, let's say, mature markets for fintech, which is UK and the US. When it comes to the 117 million that Philippines has, UK is half or about half that population, whereas the US is about just under 3 times that population. So it's not really a near fit at all. India, of course, we all know is not even a comparison at 1.42 billion. It is the largest human population on earth today. But when you look at median age, an interesting thing comes out, right? The median age, as we just saw in that Menti quiz for Philippines, is 24.9. I've rounded out to 25. For India, it is 27.5. I've rounded it out to 28. And that's where there is the demographic dividend that was being spoken about in the morning. Both these countries enjoy that. In fact, the amount of Gen Z population that will come to the fore of employment and will access financial products in the next 5 years is very similar in terms of percentages, both for Philippines and in India. In comparison, US and UK are much older populations, at UK being at 41 years and 39 years for the US. Now let's look at internet penetration. Again, huge headroom for both of these markets to grow, with 73% being Philippines India, though much larger in absolute numbers, again, that's the reason absolute numbers for India won't matter much. We look at percentages, a huge headroom for growth and acceleration, right? Whereas the two mature markets we're speaking about are already very well penetrated. And by the way, internet penetration, social media penetration, younger population which are digital natives is actually the sweet spot of fintechs. And that is why, as you come down and you look at smartphone penetration as well as social media penetration, especially on smartphone penetration and the future headroom for growth on percentages, India and Philippines are again similar. The dotted yellow boxes are remote or near about fits, whereas the solid yellow boxes are close fits, right? For me, India lines up a lot more as a peer growth comparison market than some of the mature markets that exist on this slide. Now, let's switch gears, and having picked India as the fintech peer growth market to compare Philippines with and derive learnings from, let's look at where the Indian fintech market stands today. What is that state of the union today? First and foremost, let's look at certain drivers, right? The first driver is there's a very big demographic dividend. Gen Z and millennial workforces have come to the fore, and we'll try to quantify this. The second is the rise of internet penetration. I gave you some percentage numbers, but we'll look at some more attributes there. And then third is the rising per capita income in India, and that's happening, by the way, in Philippines as well. Firstly, 20 million Gen Z consumers filed income tax returns, which means that they had proper income and they were employed. 667 million smartphone users, 759 million internet users. The largest base which exists in those four comparison markets, only China is larger. Globally, India on these metrics is the second largest. There is a little bit more of confluence happening of digital trends, which is there's been a 41% increase, which is the largest globally that has been seen, specifically only in India, of time spent on mobiles. And this happened again due to the pandemic. The second thing that's happened is there's a 30% increase in monthly data consumption. And mind you, India is home to the cheapest internet data plans globally. And there's been a 56% shift in consumers who never wanted to use online banking or sparingly used it, but now are open to use it. Then 60% growth has happened in gross net income in just last 10 years, which is the rising incomes point that I spoke about earlier. And then there is a 6.3 GDP growth number, which is a bright spot in the overall gloom and doom global economic story that we hear about every day. What this all means is an evolving digital consumer put together with a dynamic financial ecosystem presents an unprecedented opportunity for Indian fintechs. But what have been some other macro growth drivers, and maybe I'll bring some more nuances beyond just the high level headline details that I just shared earlier. Now, this slide has three kinds of tailwinds, right? The first one is acceleration of consumer reach through initiatives, right? The second one is the actual evolution in the fintech ecosystem itself, represented by blue, and green represents government initiatives, especially in building digital public infrastructure as well as goods, right? These are the rails for fintech and global digital, well, local Indian digital acceleration, right? Now the story really starts with some consumer reach tailwinds, which started way back in 2007 with the rise of smartphone adoption. And then in 2008, we had mobile banking, which was launched, and then 4G networks released. And like I said, we have the cheapest internet data rates today, and that's thanks to mobile plans that are made available by a very large conglomerate called Reliance Jio. I'm not sure if you've heard of it, but they launched their plans in 2016, which was basically free calling for life, and you've got very low data price points, right? The next one is the blue evolution in fintech ecosystems, right? We had in 2012 really the fintech ecosystem start in India with digital payment players spawning there. And then there was the entry of some MSME fintechs. And then in 2014, 2015 timeline, we had the entry of lending fintechs. Along with the digitization and the increased smartphone penetration again around the 2015-2016 timeline, what happened was there was an increased acceleration of fintech lending from 2015-16 onwards up till 2019, and then of course in 2020 there was the pandemic, right? But what happened during the pandemic was, and before the pandemic also, in 2016, there was demonetization in India. What essentially the government did was they invalidated currency notes to kill the black cash economy, right? And you had to basically come and exchange your notes. And when that happened, cash basically just went out of the system and acceleration of digital payments really happened. And just a couple of years before, NPCI, which is the National Payments Corporation of India, had launched something called the Unified Payment Interface. It was the common rails, which was a common set of protocols that connected all banks. Now you could transact with any bank. It did not matter if you were transferring money to, let's say, the lady in the front row. Which bank she banked with did not matter. I only needed to know her name and her almost like an email address on the bank, and the money would just immediately go. It was as simple and intuitive. In fact, UPI is now a global case study, and UPI is being exported to other geographies. And then that has led to the rise of digital payments, and along with it, digital credit as well. Because along with digital payments, which got plugged into e-commerce platforms, came the need for credit, because it is still a problem for consumers in India to have affordability and liquidity to make purchases which are generally aspirational in nature. And that's happened with Gen Z consumers a lot, right? Finally, I'll go to a couple of other government initiatives. I spoke already about demonetization and UPI, but first and foremost, the biggest disruption that they caused was in 2009 with the launch of the national ID, which is called Aadhaar. Of the 1.4 billion people, almost 1.1 billion people already have an Aadhaar number. Now, that set up the first layer of a critical digital public infra, which is called the identity layer. Followed by that was the payments layer with the launch of UPI in 2016. And finally, in 2018-2019 timeline was the launch of the account aggregator ecosystem, which is essentially the open banking ecosystem, which was the final layer, which is called the data layer. Now, these three layers really accelerate the entire economy, and that's essentially what's playing out now. I feel that the Philippines ecosystem overall, I feel as a geography, you are set up very similarly. You've got a very progressive, forward-looking government trying to drive digital initiatives, trying to invest in education, in digitization, and then there is a critical mass now of fintechs and of consumers who are ready to consume financial services and need that inclusion. Some evolution trends. This represents the 1,500 plus fintechs that exist in India. It's like a landscape view. There are 450 plus which are focused on digital lending alone, right? And they're all enabled by a very large e-commerce economy as well as a consumer internet economy which sits on the right-hand side. The core of digital lending is essentially broken up into three important segments: payday and online personal loans. The second one is embedded finance with online point of sale lending and buy now, pay later. There are many phrases which are used globally for these. They all mean broadly the same thing. And then a moderately growing SME lending ecosystem as well. And then there are other fintech segments which are noteworthy too, which are digital payments, which is the most valued ecosystem, as you will shortly see. Neobanking, which is growing now, but is still at an early nascent stage. And by the way, neobanking for most of you, when it comes to India, is essentially I am having a fintech app which has a very nice user interface, but I'm still offering credit products and other savings products or deposit products from manufacturers which are traditional in nature. The reason I'm able to do that is because I'm deeply integrated with different banks. I've done the curation of these credit products and these depository products, and I'm offering that through a tech-forward user interface with deep integration with the bank. It just completely accelerates the way you apply and interact with the bank. That's what neobanks are all about. And then wealth tech is essentially investments in mutual funds and public markets. Like I mentioned, there's a very large enabler ecosystem of aggregators as well as tech fin platforms which are offering stacks not just to fintech lenders but also to banks to make them more digital in nature. And finally, e-commerce and consumer internet companies which are driving the scale when you plug in any of the financial products into those platforms. Because guess what? Some of them have volume significance upwards of 350 million individuals in the country interacting on a daily basis on those apps. Now, for a quick funding view, in India, in H1 2023, for the top three segments that we spoke about, which is payments, digital banking and buy now, pay later, and then lending, we've seen about 1.6 billion plus invested, but that's been a steep drop from the highs we've seen again in 2021 and 2022. It just mirrors what's happening globally. However, we have reason to believe that India today is a very bright spot amongst, again, the gloom and doom story. That's also because VC investors in India primarily come from the Silicon Valley and Wall Street, right? That's basically California as well as New York. And they have long looked at China as a very high potential, attractive market, but of late, that optimism has gone, and as a result, India has emerged as a more preferred spot for VC investments. So we believe this market will come back very, very soon. In Philippines also, we've seen a very similar VC funding trend. I'm not putting up that slide. However, the only difference is while we're speaking about a few $1 billion in India, in Philippines we're speaking about a few $1 million. The same value for H1 2023 stood at $3 million that was raised. Having said that, in 2021 and 2022, even Philippines saw the highest ever rounds of financing. So they're sitting, Filipino fintechs are sitting on a lot of dry powder, which will be capital deployment, which will hopefully happen very soon and will drive growth. Now, some quick trends just to kind of cycle through. It's a complex slide, but just if you follow my narrative, I will decode this, right? What's happening is rapid pivots and convergences happen in the market, right? We spoke about the smartphone spike. We spoke about the UPI growth. It's, by the way, just for context, 9 billion plus transactions on digital payments monthly, right? It's the highest globally ever. There has been a big tech entry, meaning Amazon, Google, Samsung, and Apple, by the way, all have very big financial services players in India. And then there's been the rise of buy now, pay later. What's really happening is, if you think of what a bank does in a market, fintechs in India have broken each play down and started large scale lending plays in each of those segments, and then realized that there is a little bit of a challenge on profitability, and finally they've pivoted and entered some other markets, and hence there is a driving convergence that's happening, as you can see on the right hand side. Just for example, right, you've got fintech lending and then TechFin platforms. You've got a green Zest Money logo there, which does fintech lending, but also offers its entire fintech stack as a SaaS platform. Similarly, you've got a Google, which is a big tech, which also does hyperlocal e-commerce, and it also exists in digital payments as GPay. It's different from Gcash, that's Google Pay, and they've got the largest scale in digital payments for Google globally in India. Similarly, Amazon, which was supposed to have a very large play in the US, has now ended up having a much larger play in India. So Amazon entered the digital payments race a little bit late. It was a laggard. But what it did very smartly was it went and it uh, put some VC investments into an NBFC called Capital Float out there. Capital Float is now called Axio. That story aside, essentially what Amazon wanted to do was it wanted to enter credit. It did not want to get regulated by the central regulator in India. So it just made some VC investments into another regulated entity and drove it to power its consumer BNPL play. So a lot of convergence is happening, which basically means it is hard to quantify or qualify or categorize any fintech as only lending or only payments or only neobanking. It cuts across now. Secondly, it's passe now to think of any entity as a client or a competitor or a collaborator. I think the lines are completely blurring. You equally compete, collaborate, and serve each entity in the ecosystem, such as the nature of business. This is completely clearly playing out for us in India, whether we as a bureau or a fintech, right, serving banks, it's just the same. You collaborate with a bank, you also serve a bank on certain needs, and finally, you compete, of course. And then sachetization is playing out. And what is sachetization? It's an FMCG concept where if you were to offer a large bottle of shampoo in an emerging market, it won't sell. You create small sachets, price it more premium for the volume you're selling, and it just becomes more nugget size, more consumable, and just flies off the shelves. That happens in India, it happens in Africa, it happens in Asia as well, right? And that's happened to credit as well and to payments. What we've seen is the under 10,000 ticket size when it comes to Filipino pesos, and I'm basically just converting Indian rupees to Filipino pesos. But just for context, the under 10,000 Filipino peso ticket size happens to be the fintech sweet spot, both across India as well as Philippines. And that's seen 55x growth in 3 years. Just absorb that for a minute. This is not 55%. This is 55x. We've spoken about the government being progressive on digitization, financial inclusion, but also on MSME pushes, right? That's the other thing. We're dealing with progressive governments in India, and I sense that looking at all the content and hearing all the talks with all the interactions in Philippines as well. There's been, by the way, a little bit of catching up of digital lending regulations in India, where there's been a strong crackdown on illegal lending apps. There's been the launch of digital lending regulations in India, unethical lending practices and collections practices, which existed and probably helped fintechs scale early in the market, are just now going out of the window, right? What that has done is there's a higher need for disclosures and compliance, smarter risk-based pricing, because if your book quality is going to be assessed and your loan rates are going to be higher and your cost of capital is going to be higher, you have to price for that risk, right? So a lot more intelligence in your lending practices needs to go in. And then there are needs of higher analytical solutions for risk management and collections that are coming forth. Another very interesting thing that happened in India and was a catalyst for the growth of the fintech ecosystem was this concept of FLDG, which is essentially first loss default guarantee. It's a synthetic risk sharing arrangement where if a fintech doesn't have a lending license, I can just go to a bank and say, hey, can we partner? I don't have a lending license. I have to wait 2 years to get a lending license. You have one, but I want to extend loans to your book. But the problem is the bank says, hey, you know what? You're going to onboard a lot of risky customers. I'm not interested. Your loan ticket sizes are too small. You'll never make money. I'll never make money. I'm not interested. To which the fintech said, hey, guess what, Mr. Bank? I'm here to cover for the first 5 to 10% of all risks on the portfolio I source for you. Are you game? The bank said, hey, doesn't sound bad. It can help me diversify and grow my consumer bases. It can also help me experiment with fintechs and help me understand also what this entire fintech revolution or fad is all about, which is essentially the conversations which were happening back in 2016. Banks thought, hey, you know what, these guys are here, it's a temporary fad, these guys will go away, but while they're at it, let me learn from them by partnering, right? But that rationale and that entire narrative has thankfully changed, and it's a much more mature collaboration that happens now in India. That said, in 2023 early, after RBI, which is the central banking regulator in India, clamped down on FLDG, and it basically collapsed all the fintech collaboration with banks and really put a huge speed bump in the fintech growth story in India in late 22. In 2023, after deliberations with the ecosystem, they have reintroduced that, but only to an extent of 5%. So they've made it range bound, which basically means regulators, not just in India, but in other geographies, are increasingly participating in debates, conversations, consultations with the ecosystem, and then coming out with rational policies which are balanced with innovation as well as controlling of systemic risk, which is played out here, right? Now, there are three phases of evolution we've seen in the fintech ecosystem. I'm just breaking it down by timelines. Phase one was the 2012 to 2015 stage, where fintechs were largely launching and testing the market. There were primarily digital payments players as well as marketplace aggregators. No real lending players, or at least meaningful ones. There was low innovation, and largely there was a lift and shift model from mature markets like the US and the UK. And there was easy VC funding. All you needed to say was, hey, I'm the Stripe for India. Hey, I'm the money supermarket for India. And VCs would put money into you. You know, we speak about the VCs funding an idea on a napkin. This was that stage. Not a very meaningful stage, not very scaled, but it was phase two where a lot of interesting things started happening, which played out from 2016 up until the end of 2019, where a lot of pivots and differentiation plays happened. That was really when the rise of digital lending and UPI-based digital payments happened. Innovative credit products and rapid pivots happened, and there was still relatively low regulation. The regulator was waking up to the reality of fintech being a meaningful and a powerful force in that financial services market. VC funding, by the way, accelerated. Some growth stage and late stage rounds started happening, but there was still weak diligence, right? It was more diligence than the phase one, but it was still weak diligence. And then came the pandemic, right? Which put a huge speed bump in the growth of both digital payments and credit. But then when the lockdown started opening up, it was digital e-commerce which really started. With it started digital payments, and then digital credit followed. Why digital credit followed was because in every market, the governments had given a repayment moratorium, a repayment holiday. So lenders were very scared to start lending again, which is what played out in India as well. But what's happened since is initially there was a little hesitation to start post the lockdowns opening up. But after that, there's been a strong rebound. There's been a very strong growth that's happened. And that's again deployment of the dry powder we spoke about. There's been a rise of embedded credit and buy now, pay later. And now regulatory scrutiny has increased and digital lending regulations have come to the Indian market. VC funding has gotten crunched a little, and there is a high focus on profitability as well as the book quality that is getting sourced. Why I speak about these three phases is because I feel Philippines today is in phase two. It looks very much like India's phase two, where you are just geared for this massive disruption, this inflection point in growth in the next 3 to 5 years, right? And some of these learnings around regulatory compliance and uh, product fits that really have scaled well could be lessons that you could take from the India playbook. Just moving on very quickly, only key messages here are the Indian fintech ecosystem evolution story that I spoke about across 3 phases is represented on your right-hand side. It is today an ecosystem valued at 65 billion. Highest valuation sits in 38 billion for digital payments. Consumer lending comes second at 11 billion. You've got neo entrants at 7 billion and then 4 billion and 2 billion for SME lending and neo banking. But it is also a very young ecosystem. 67% of all Indian fintechs active today were founded in only the last 5 years. Now, let's look at how Indian fintechs have really gained market share. What have been some of the smart strategies for them to scale versus competition which were incumbents? The first and foremost has been a focus on consumption-led credit products, which is essentially personal loans and something which is unique to India, which is called consumer durable loans. Essentially, I go into a retail store, I buy a washing machine on credit. The credit is not disbursed to me, it is disbursed to the retail store or to the manufacturer where there's a little bit of subvention of interest rate. Okay? Long story short, I as the consumer do not get money in my savings account. I only get the consumer white good that I need, right? A washing machine, a smartphone, a TV, right? The money is actually disbursed to the retail store. Now, what's happened is those two credit products have typically accounted for 96% of all fintech disbursals in Q1 2023, but that's been the trend throughout. It has funded, as a result, everyday consumption use cases, right? And that's where fintech lenders are starting to occupy mind share over traditional lenders. Traditional lenders typically offer high ticket net interest margin based products which have 3 to 5 years tenures, right? Consumers have sparing, infrequent needs of those credit products. But with fintechs, you've got very small ticket sized, 3 month, 2 week kind of credit product constructs which fund everyday, very frequent use cases, which help them occupy the mind share of the consumer. And guess what? If you want a higher ticket credit product, whom will you go to? The lender that you've been banking with rather than the traditional lender. That's what's playing out. NBFC lenders, just for your reference, are similar small lenders, but they're not very digital in nature, right? Private banks are digitally enabled, but they are very profit focused, very compliance focused, right? And very large balance sheet owners. Government banks are more of your traditional lenders who will drive lending as per some government mandates and regulations and directives, right? So what you'll clearly see is on consumption credit products, there's a clear rank ordering, right? NBFC lenders come in second, private banks come in third, and government banks come in last. Guess who's going to lose the mind share of consumers in the years to come? It is the last two lenders. It is the fintechs and the NBFC lenders which probably will gain maximum mind share. Now, what we've seen in the last 5 years is a massive increase in the demand for personal loans that consumer lending fintechs have seen. And that has been a 28.6x growth in consumer demand, right? And I'm speaking only about personal loans. The number for consumer loans and business loans are not small either, but personal loans is head and shoulders above as the most popular credit product construct that is done by fintechs. When it comes to disbursals, which is the issuance of credit or the supply of credit, that has grown even faster. Fintech lenders are known for having open credit policies. They are known for being able to leverage multiple sources of data and deeply work with credit bureaus like us in markets like India to be able to drive automated credit decisions. And what that does is you're able to supply much more rapidly in personal loans, which are simplified for everyday use cases. And that's seen in 82.7x growth in 5 years. Not working? Okay. Now, fintech lenders have also diversified geographically over time. How that's happened is very interesting. Now, to begin with, in 2018, fintech lending in India was primarily a metro and urban concept, right? Simply because fintechs were just starting out. They did not want to take the risk of collecting in geographies where they did not want to have physical presence. They wanted to have digital distribution models, and that's where you'll see metros and urban accounted for a very large share. But over time, that diversification has happened. You'll see the reliance on metros has come down to 32% from 47%. And in urban, while it stayed pretty much stable, what's increased is the share of semi-urban and rural when it comes to originations by fintechs. And most of this was accelerated post the pandemic when there was a lot more capital to deploy, a product market fit had been found, and then they were confident enough to be able to drive collections in the post-pandemic world, which was much more touchless and contactless, right? And that's clearly played out here. Now, what happens when you look at age distribution? And what you'll find is versus any other lender type, fintechs have a very high composition of younger borrowers, right? So you'll see Gen Z and younger millennials have a very high composition of 73%, right, of the overall fintech lending. It's more young than any other lender segment here. And that's because these are digital natives. The distribution model is through mobile apps, through internet, and who spends the most time on internet? Younger consumers who like social media. What about the evolution itself? Has that evolved for fintech lenders? Sure, they are serving consumers younger than other lenders, but let's look at the evolution itself. And there is an interesting evolution that's happening as well. Gen Z consumers, which are today 25 years old, that's the oldest Gen Z consumer today, that composition has come down to 33% from 39% 5 years back. But there's been an increase in the 26 to 25 to 35 range, which is your younger millennial, right, range. I'm an older millennial. 26 to 35 is a younger millennial. That's grown a little. So has the 36 to 45. What that really means for fintechs is you're actually tapping into consumers who are not just desperate for credit or just are digital natives, but they are also, sorry, I just lost my thought. So, sorry, okay. Yeah, so there's a growth in millennials. These consumers are looking for convenience. Older consumers look for that, and that we've clearly seen play out. When it comes to NTC, sorry, we are having some. Okay, in terms of risk bands, we've seen an expansion in subprime players. Fintechs are trying to prioritize profitability. They're taking on lesser risk over time in the last 5 years. New to credit focus from the beginning to now has gone lower. Applications processed same day is very, very high for fintechs, right? And when you compare it with other lenders, what you'll find, in fact, for PL, it is very, very high. 58% of all fintech applications get processed today in 2022 and on the same day. Now, STPL happens to be a fintech sweet spot. What we found in India is 10,000 peso and below ticket size has grown very materially. We're seeing about 1 million approximate borrowers getting included every month. And the number of accounts is closer to about 5 million, which basically means accounts per borrower stands at about 3 accounts per borrower. So very high repeat consumption behavior is showing. When you speak about this segment of under 10,000, you'll see that there is again a stable growth that's happening. But the under 50K segment is composing of two interesting use cases. One is everyday, very small ticket credit needs. The other is premium goods purchased on credit of smartphones and consumer durables. In Philippines, a similar trend though is slightly different. The under 10,000 K Philippines personal loan ticket size as done by fintechs has stabilized at a 46% level. There's a much higher focus that Filipino fintechs have on personal loans in higher ticket sizes than Indians do. When it comes to age, lots of commonalities. Personal loans as done by fintechs across both markets account from younger consumers for 70%, right? That's the younger people skew, which is again common across India and Philippines. And Filipino fintechs have driven inclusion via small ticket PL in lower income band populations. So 69% of small ticket PL is given to consumers with an annual income of 300,000 pesos or lower. Now, my final slide, I'm just about to wrap up. Some learnings and takeaways. Innovation and digitization is a force multiplier. Important to right now get the product market fit for Philippines. Small ticket PL, buy now, pay later, challenger cards, embedded credit are most popular globally. Could be the right ones to bet in the Philippines market. Embedding into everyday use cases and partnering with e-commerce platforms extremely important in driving scale. Ecosystem collaboration is essential. Banks will always have a rate advantage. They will always be able to cross-sell better, and what products you don't offer, your partner bank can offer, and that's where profitability will come in. And they will also help you comply with regulations. E-commerce platform partnerships is the second partnership which allows for reach and scale. Regulatory compliance should not be taken lightly, right? Regulations will eventually catch up as they did in India. I spoke about all the problems where there was a clampdown, and that's finally now led to a little bit of a trust deficit between the regulator and fintechs. It takes time to repair that damage. Unit economics and profitability in today's gloom and doom economic environment is important. That's where VC money will go, and that's a given for every market. Important to start focusing on it from the get-go. And finally, data quality and access is essential for automation. We've been able to launch a lot of nuanced underwriting solutions because we've got data contributed by members, and that kind of collaboration in the Philippines ecosystem will also help you do more and help us serve you better. With that, thank you so much. I hope you found this informative. I really enjoyed being here. Thank you.